If you're watching the crypto charts right now and feeling that, that familiar high anxiety pit in your stomach, you are definitely not alone.
Oh, absolutely.
The market pressure has been just intense, and we've seen weeks of brutal selling. It's left the whole space feeling, well, volatile and nervous.
Mm-hmm.
So for you, the learner, whether you're prepping for a presentation or just trying to manage your own risk, cutting through that noise to find some real clarity is everything right now.
And that anxiety is well-founded. I mean, the reality we're facing today is that sellers are firmly in control.
Yeah.
We've seen the price action fail repeatedly to find any kind of sustained floor. And it's dropped us into what I can only describe as an uncomfortable middle zone.
And what happens in that zone?
Well, when you're stuck there, volatility doesn't just increase, it can accelerate and fast.
So our mission today is clear. We're doing a deep dive into the underlying data. We've analyzed the latest price action, the massive technical warnings being flagged by top analysts.
And the macro overlaps, which are just inescapable right now.
Exactly. And critically, the key fundamental and regulatory shifts happening in both Bitcoin and Ethereum.
We're basically pulling the nuggets of knowledge from all these sources to understand the true signal behind this weakness. Is the market structure fundamentally broken, or is this just a brutal short-term cleansing?
Okay, let's unpack the Bitcoin technical breakdown immediately because it feels like a critical failure.
It is.
BTC has sliced right beneath that important $98,000 to $100,000 support area.
And it closed the week near the 2025 yearly open at 93,300.
But what really stands out to me is just the sheer scale of the rejection we just witnessed.
The rejection is stunning, especially when you look at the institutional commitment that was supposed to stabilize the price.
You're talking about Michael Saylor.
Exactly. He revealed an $835 million BTC purchase just last week. The reports say it was executed around $102,000.
And even that wasn't enough.
That massive injection of institutional capital could not hold that level. It just failed.
Wow. That's almost $1 billion of institutional conviction failing to stop a breakdown. It underscores how aggressive this selling pressure really is.
It really does.
So if we look at the flow data beyond Saylor, what are other institutions actually doing?
Well, they're signaling a broad retreat from risk. We're seeing negative ETF flows. And maybe more tellingly, the Coinbase premium is firmly below zero.
Okay, help us understand that mechanism. We know institutional players really lean on Coinbase for their big orders. What does a negative premium on that exchange actually signify about their behavior?
A negative Coinbase premium means that the primary channel for U.S. institutional flow, which is Coinbase, is bidding significantly lower than international exchanges.
So they're not buying.
They're not buying aggressively, they're taking a break, or they're executing sales and hedges somewhere else. And this institutional retreat has pushed the overall market sentiment into extreme fear territory.
And we know extreme fear can often signal a short-term bottom, but it's no guarantee.
Not at all.
If Bitcoin is going to stabilize here, what's the absolute minimum it needs to reclaim?
It has to reclaim $100,000. That is the psychological and technical line in the sand.
And if it doesn't?
If we reject that level and move lower, the sources all point to a really serious issue. There is very little structural resistance between the current price and much, much lower levels.
So the floor is thin?
The technical structure is thin right now, yeah. It means volatility can take us down fast if the sellers keep pressing.
That leads directly to the major technical warning flagged by the analyst Benjamin Cowan. And this is where it gets really interesting, because it connects this cycle to historical precedent.
Yeah, this is a serious red flag that requires attention. Bitcoin just closed below its 50-week moving average for the first time in this cycle.
And historically, that's bad.
Historically, if you look back at past post-halving cycles, closing below the 50-week MA has been a prerequisite for those deeper, longer bear market drops. It's often the signal that the exuberance is truly over.
But we hear about the 50-week MA every cycle, and with nearly $1 billion being bought at $102K just last week, isn't this potentially just a massive shakeout of retail? Is that 50-week MA still as reliable today, given how institutionalized this market is now?
That's a great question, and it adds some necessary skepticism. I mean, historically, its weight is enormous, but its power in this cycle is being tested by all this institutional money.
So what does Cowan say?
Well, his analysis accounted for this. He provided a very specific caveat. One close is not confirmation. He specified that if we see a second consecutive weekly close below the 50-week MA,
Then it's serious.
then the probability of the cycle top being confirmed, meaning the bull run, is overjumps to around 70%. So yes, it's a historical warning, but the next few days are the real test.
What's truly fascinating, and what makes interpreting this drop so difficult, is the sentiment Cowan highlighted. Unlike previous bull tops, which were defined by, euphoria and mania.
Full-blown mania.
Right. This current environment feels much more like apathy.
Exactly. And this apathy is unique for what was potentially a market peak. In past cycles, everyone was talking about being millionaires on paper.
Yeah, you couldn't escape it.
This time, even the high was met with skepticism and sort of measured institutional engagement. This apathy suggests the market structure might be different, less fueled by retail emotion, more governed by macro flows.
But okay, let's say we accept the worst case scenario. The cycle top is in. Analysts still expect some form of relief, right? You don't usually just crash straight down forever.
Absolutely. Even if this is the start of a deep correction, analysts expect a strong relief bounce back toward the 200-day moving average at some point.
And where is that sitting right now?
That average is currently estimated to be in the $60,000 to $70,000 range.
Mm-hmm.
That would be a crucial point for traders to reevaluate.
Okay, shifting gears, let's bring in the macro environment because, technical weakness never happens in a vacuum. We have new pressures driving uncertainty, specifically from the U.S. government.
Yeah, the biggest near-term source of volatility is the U.S. shutdown ending. Now, this might sound minor, but it's crucial. Markets now have to absorb a massive backlog of delayed economic data.
So CPI updates, employment figures, all that stuff.
All of it. Consumer confidence reports, you name it.
And why does that backlog specifically drive volatility?
Because traders and institutions have been running their risk models on, stale assumptions for weeks. They now have to rapidly ingest and reprice macro conditions based on fresh and potentially surprising data.
A sort of data whiplash.
Exactly. That repricing of risk almost guarantees a jump in volatility.
Oh.
And on top of that, we still have geopolitical friction, like the rising tensions between the U.S. and Venezuela, which just adds another layer of global risk aversion.
Let's talk liquidity. Is there any relief expected from the monetary policy side that could offset some of this pressure?
Liquidity is definitely thin right now, which is why these price moves are so exaggerated. It is expected to improve somewhat as the Federal Reserve pauses quantitative tightening, or QT.
But there's a catch.
There's a catch. We need to be cautious here. Historically, improved liquidity takes time, sometimes months, to actually translate into stronger, sustained risk appetite for assets like crypto. It's not an immediate flip of a switch.
So if we put all of this together, the technical weakness, the macro uncertainty, the slow liquidity recovery, what's the near-term outlook into December looking like?
Well, current expectations strongly point toward unchanged interest rates in December. So when you have this convergence of severe technical warnings, unresolved macro, and tight liquidity, crypto is likely to stay under substantial pressure into the end of the year.
A waiting game.
It's a waiting game where patience is absolutely necessary.
But if we zoom out, what does this current dip mean for the long-term structure? If Bitcoin does crash further down, is the broader bull market fundamentally broken?
And this is the crucial safety net for long-term holders. Even if BTC dips significantly lower, say toward the $75,000 region, the larger structural trend remains intact.
How so?
Because that level would still represent a higher low above the key April 2025 bottom, which was around 74,000. The long-term bullish structure does not break unless those foundational levels are decisively taken out.
Patience is the word of the day for Bitcoin, but I'm having trouble squaring this brutal technical picture with the overwhelmingly bullish fundamental take we saw from Coin Bureau on Ethereum. Are these two just completely decoupled right now?
They really do appear decoupled at the fundamental level, yes.
Yeah.
While Bitcoin is dealing with cycle risk, Ethereum is marching toward a massive positive catalyst, the Fusaka hard fork.
That's scheduled for December 3rd.
Yep. And this isn't just one update, it's a whole package of 12 powerful protocol improvements.
Okay, tell us about the key component EIP 7594, known as Pure DOS. Why is that one so vital?
EIP 7594 is a huge engineering leap focused on ultra-efficient data handling. And why that's important is because it directly unlocks better performance for all the layer 2 scaling solutions.
So Arbitrum, Optimism, all of those.
All of them. This is how Ethereum scales dramatically without compromising its core decentralization. It makes the entire ecosystem faster, cheaper, and more viable for massive user adoption.
So this is foundational work that strengthens Ethereum's core utility, especially for traditional finance players who need that scale and reliability.
Precisely. These types of upgrades solidify Ethereum's long-term positioning as the institutional liquidity layer. Wall Street doesn't just need a store of value, they need a reliable, high-performance platform for future tokenization and settlement. Fusaka delivers on that promise.
And beyond the Fusaka launch, what's the next major catalyst that could drive institutional flows specifically into ETH?
It's all about the pending ETF approvals that include staking rewards. If institutional products can offer both simple price exposure and the yield from staking, that fundamentally changes the risk-reward profile of ETH for major wealth managers.
We can't close without acknowledging that despite the short-term price weakness, global institutional confidence and regulatory clarity are actually accelerating.
Let's just run through the rapid-fire signals we saw this week.
Yeah, we're seeing proactive, smart regulation globally. Japan, for example, is making a massive leap. They're preparing to reclassify 105 tokens as financial products.
And they're cutting the tax rate.
And cutting the prohibitive crypto income tax rate from up to 55% down to a flat 20%. That's an enormous incentive for capital.
And Hong Kong is aggressively positioning itself to lead Asia's tokenization race.
They've moved Project Ensemble into a live pilot, testing real value tokenized deposits. This isn't theoretical. This is building the actual rails for the future of finance in that region right now. Then you have the explicit signal from right here in the US. Harvard University nearly tripled its holdings in the BlackRock spot BTC ETF.
Which is incredible. It's now their single largest declared U.S. investment by the endowment.
That is a profound signal of long-term institutional confidence, even in the face of this volatility.
And finally, an important note on security. The DOJ seizing 15.1 million in stolen USDT related to North Korean hacking. It just reinforces that law enforcement is catching up and cleaning up the ecosystem's reputation.
So what does this all mean for you? The key tension we've covered today is stark. We have genuine, immediate technical weakness and serious macro headwinds, highlighted by that concerning 50-week MA warning.
Right.
But that pressure is pitted against deeply solidifying long-term structural resilience, which is accelerated by this powerful fundamental and regulatory progress.
So the necessary approach in this environment is, well, it's patience. You have to allow the market structure to develop without forcing trades. Wait for confirmation, especially on that 50-week MA test, before making aggressive moves.
The floor is intact, but the path is treacherous.
The long-term floor remains intact, but the short-term path is clearly treacherous and volatile.
Yes.
This raises an important question, something we want to leave you with to consider. Given the bench and Cowan noted the current market peak felt like apathy rather than the typical mania of previous cycles, what does that unusual lack of euphoria tell us about the maturity of this market? Is the reduced euphoria a sign that future corrections will be less devastating? Or does it maybe hint that we're quietly transitioning towards steady, large-scale institutional accumulation rather than that explosive retail-driven volatility we're so used to?